So great to be here. Welcome to this third session of a four-part program on starting an enterprise. So this is part 3, financial planning. If you missed the earlier sessions, we've been following the Mind Your Own Business workbook, which can be downloaded at tencommunity.net, tencommunity.net, in the resources tab. So you have a business idea in mind. We've thought through about what market research is needed and how we're going to sell our product or service. You've also thought about each step of the business process and worked out your setup costs, what you need to buy before you start. Now, before we start the business, we need to get grips with the expected operating costs and find out whether the business is viable. So, operating costs. First, to work out your operating costs, you need to be clear on your unit of sale. Your unit of sale is what is on your price list. It might be per item, like per dress, or per pack, a pack of 10 biscuits, per glass of juice, per bottle, per kilo, per ton, per litre, per hour, per day. So decide how you are going to express your cost, per kilo, per litre, per pack, or whatever it is. And so now we know how to express operating costs. These are the costs you will have to pay every month to run your business. There are two sorts of operating costs, fixed cost and variable costs, and it's important to know the difference. Some costs are fixed. These are the costs you have to pay even if you don't pay anything at all. For example, paying rent on your shop or paying a monthly fee for internet access. You have to pay for these things even if you have no customers at all. Some costs are variable. For example, your ingredients if you're making a food product, the cost of material if you make dresses, and the cost of packaging and delivery. They are the direct cost of your sales, and they increase in line with sales. If you sell twice as many dresses, you will need twice as much material. Confusingly, some costs are either or both. Wages are usually fixed if you're paying a fixed monthly salary regardless of what is produced, but they can sometimes be variable if you're paying per item produced. For example, if you're paying out workers to produce dresses. An electricity bill might have a fixed monthly charge, but also a meter charge, which increases the more you produce. A good test is, if you sell twice as much, will this cost stay the same? If so, it's a fixed cost. If it increases a lot when sales double, it's a variable cost. The distinction is important. Knowing your variable cost means you can work out your cost per unit of sale. Knowing your variable cost per unit of sale means you know whether to take an order at a particular price. If the price is lower than the variable cost, turn it down. You will lose money on it. If it's higher than your variable cost, then there will at least be some surplus contributing towards your fixed costs, though you'll need to sell enough to completely cover fixed costs. Your variable cost per unit is easy to work out. For example, if you're making 100 packets of biscuits costing £100 in total, then the variable cost is £100 divided by 100 packets, so £1 per pack. However, this is just the ideal cost per unit. Unfortunately, some of the biscuits you are making will break or be nibbled by rats or go stale before anyone buys them. Or if you're offering a service and you have timed appointments, some of your customers will not turn up, so the time is wasted. So out of every 100 units of sale, how many will you actually get paid for on average? Divide your cost for 100 units by the number of units for which you will actually be paid. This is your realistic variable cost per unit. In the biscuit example, suppose you're only paid for 90 out of every 100 packets of biscuits you make, because on average, 10 packets get dropped and are broken, or they're damaged by rats or go stale. And then the realistic variable cost is £100 divided not by 100 packs, but by 90 packs, which is £1.11 per pack. The idea of realistic variable costs doesn't just affect biscuits, it also affects many services. Suppose you run a hairdressing shop and you take time bookings. Perhaps you normally expect 10 bookings a day and you base your costs on this, but you will get some no-shows, people who forget or get sick or are stuck in traffic. If you have one no-show a day, your costs will have to be spread out across 9 bookings, not 10. Next, how do you lay this all out and work out revenue and profit? You've already thought about what price to charge per unit of sale, drawing on your competitor research. Hopefully, this is more than the variable cost per unit that you have just calculated. Let me give you a very simplified example. This is based on the example of a dressmaker in Uganda, but the principles apply to any business in any country. The example is in the back of the free workbook. So this is a very, very simple profit and loss. First question, how many units do you think you will sell per month in the first month of trading? Probably not very much, because it takes a while to find customers. In this case, the dressmaker thinks that they'll sell just 2 dresses. What about month 2? Well, in this case, they think they might get up to 4 dresses and then 6 dresses, 8 dresses, and so on. So that's the first 6 months of their sales forecast. Most businesses gradually build up sales in these first few months of the business. And likewise, you need to forecast how you can build up your sales volume month by month as one row of a table. This sales forecast is crucial, so try and be as realistic as you can. In the next row, multiply the number of units you think you will sell each month by the price to give the total revenue per month. In this case, the dressmaker expects to sell the dresses at an average price of £10 per dress. So the magic of Excel, you can see now the revenue in month 1, 2 dresses at £10 each, 20 quid. And the next month, 4 dresses at £10, 40 quid, and so on. That's the sales revenue line. Of course, it's much simplified. In real life, there might be a range of dresses at different prices, and the business might sell other things like shirts as well. There might be a different row for each group of products, and then a total sales revenue line. In the next row, multiply the number of units sold by the realistic variable cost per unit to give the total variable cost per month. In this example, the variable cost is thought to be £7 per dress. That's the cost of the material. And so in the first month, the dressmaker is having to pay for 2 dresses at £7 each. That's £14 worth of material. The next month, 4 dresses at £7 each, so £28, and so on. Again, you might split this into several lines: materials, haberdashery, labour, and a total variable cost line, but let's keep it simple. This line is also sometimes called the direct cost or the cost of sales. The revenue each month minus the variable cost gives you the gross profit. You can see revenue of £20 less the variable cost of 14, a gross profit of £6. And then the next month is £12, £18, and so on. Then you need to put in the fixed costs. So in this case, let's assume that the dressmaker is renting a market stall for £15 a month. And that then generates the operating profit. So you have a gross profit in the first month of £6, but a fixed cost of £15. So in fact, in the first month, you'll lose £9. Do you get that? £6 less 15, so a loss of £9. The next month, doing a bit better with 4 dresses, only losing £3. The next month, selling 6 dresses, you've got a gross profit of 18, £3 per dress, and that means you're generating an operating profit of £3, and so on. So we now have what is a very simple table called profit and loss, or P&L. This one's a forecast. It's what we hope or expect to happen. When you change the forecast figures for actual figures, it becomes the basis for the actual company accounts. If you use accounting software, you should be able to press a button and get your P&L for any period you request. Whether or not you appear to be profitable, it's helpful to know your break-even point, the minimum amount you need to sell to make an operating profit. Your break-even point is where the gross profit first covers all of the fixed costs. In this example, every dress sold contributes £3 towards the fixed cost. That's £10 less the variable cost of £7. Fixed costs are £15 a month, so the business has to sell 5 dresses, each of them making £3, to break even. Now, drum roll, there is one forecast that is even more useful when you start, a cash flow forecast. The most important question at the planning stage is to find out whether your business idea is viable. Will your business succeed or fail? This comes down to 2 questions. Do you have enough cash, and will the business be profitable? These are not the same. Fast-growing companies can run out of cash and therefore fail, even though they are making a profit. To see how much money you need and to make sure you don't run out of money, you need a cash flow forecast. So here is, hopefully you can all see that. What is a cash flow forecast? You personally might see financial statements sometimes, such as a bank balance, bank statement, or a mobile phone statement. Typically at the top, these say opening balance, the amount you had in your account at the beginning of the month. Then there'll be a list of the money that was paid in during the month, credits, and also everything that's gone out during the month, debits, the payments you've made. At the bottom of the statement, it will say closing balance, the money you have left, and this becomes the opening balance the next month. A cash flow forecast is simply a best guess at what your statements will look like in the coming months. What will your opening balance be when you start your business? What will you have to pay for during that first month? Will you receive any income during the first month? What will be left over? A cash flow is different from a simple list of your income and costs, because it records not when you raise an invoice, but when you are actually paid, and not when you get the bill, but when you actually pay it. It literally records the flow of money in and out of your account. So a cash flow forecast is a different table from a P&L forecast. But I've adapted the earlier dressmaker example and magically turned it into this embryo cash flow forecast. Once again, I'm keeping it very simple to start with. There are several differences from the P&L table that I've alluded to. One is that I've added the setup cost, which we discussed earlier, and a new column to cover cash movements before the business starts trading. In this example, let's imagine the only setup cost is buying a sewing machine for, let's say, a couple of £100. Of course, there'll be other setup costs, but I'm keeping it simple just so you understand the principles. So I've also added rows for the opening and closing balance each month. So as it stands, £200 is spent before the business starts. So there's a minus £200, and the business starts at the beginning of month 1 here with minus £200 in the bank. We're doing this assuming there's no loan at the moment, just so we can see how much money is required. Then, if you remember, we made a loss of £9 in the first month. So at the end of the month, we've got minus £209, and that's carried up to the beginning of month 2, make another loss, £212 loss, which is then, that's the bank balance at the end of month 2, carried forward to the beginning of month 3, and then hurrah, we make a profit, £3, and the overdraft begins to drop, and it gradually improves. The sharp-eyed among you will see that I've deleted the gross profit row and renamed the operating profit line as cash flow in month, or cash movement in this period. For the moment, I'm assuming that the business buys the material the same month that the dresses are sold and receives payment immediately the dress is sold. With these slightly unrealistic assumptions, the cash flow in the month is actually the same as the operating profit, this line here. But the point is that we're not forecasting profit here. We're forecasting cash movements, which are not usually the same. The cash flow forecast enables us to see how much money we need to start the business. So I've added a line for the loan, which we can fill in when we know how much we need. One of the useful things that this table shows is how much money the business needs to start. The startup cost is the setup cost, there's the £200 there, plus the losses you make in the first few months. This business will need at least £212 in month 2. To be on the safe side, the business should have access to more money than this, say £250, in case the sales estimates are too optimistic. So I could put a loan of, say, £250 in there, and then you can see the cash flow is nicely positive, or rather there's no overdraft in the account. As I said, a cash flow is different from a simple list of income and costs because it records when you pay and when you will be paid. And in practice, most companies have to pay for their materials before they make their products. And some businesses don't receive payment from their customers when the sale is made. Instead, they raise an invoice, which might not be paid until the following month or later. So let's make this a bit more realistic. Probably the material needs to be purchased, needs to be paid for in the month before the dress is sold. So just bear with me for a moment. Month 1 variable costs. I'm just going to change the formula slightly to this and drag that across. Wonders of Excel. And back here. Oh dear. Let's just... There we go. So what I've done now is assume that the material is paid for the month before. So the material for the 2 dresses made in month 1, which costs £7, needs to be paid for before month 1. So that's the 14 variable cost there. And then in month 1, the material needs to be bought for the 4 dresses that are actually made in month 2. So this 28 relates to the 4 dresses there. This 42 is the material to make the 6 dresses the following month, and so forth. So you can see now the situation is a bit stickier, and even though there's a £250 loan, there is now something of a loss. So I would say in this situation, you might want to increase the loan to maybe 300 quid, and then it looks a little bit better. You can do a similar thing if the business is being paid after the goods are supplied. Maybe the dresses are being sold to a retailer, the invoice is raised, and the retailer pays in the following month. So I'm going to change the revenue figure here. Just bear with me. Change the formula. And drag that across. So now we have a situation where the 2 dresses made in month 1 don't generate any income at all. They're still there as a profit in the P&L because you raise an invoice, but the money doesn't come in until month 2. There's the 20 quid, which is your payment for the first 2 dresses. And there's the 40 quid payment for the 4 dresses in month 2, but it doesn't come to month 3, and so on. So do you see how now we're getting the money a month later? And guess what? The cash flow now looks even sicker than it was before. And I don't know how much we want. The worst case scenario is minus 48 now. If there was no loan, we'd be looking for 348. So I would say probably a loan of £400 is now needed, which is the value of doing this. You can work out how much money you need. Can you afford it? Will you have it at that particular point? So worst case is month 5 minus 348. The profit and loss is still the same. The break-even point is still the same, but the business needs a lot of operating capital to cover the gap between paying for the materials and being paid for by the customer. This can be a big problem. It means that profitable companies that are growing fast can easily run out of money and fail. But there are ways around this. Try to negotiate credit on the things that you're buying. You don't have to pay until after you are paid. And/or try and get customers to pay on delivery or in advance. For big items that take a long time to do, such as construction work, the customer might be willing to pay, say, half the total cost before you start, which reduces the risk for you and improves cash flow. As you can see, cash flow closing balances for a startup are often increasingly negative. These closing balances here. Then, if the business is profitable, the negative balance starts to reduce, and eventually the balance is increasingly positive. How negative is your worst month? This amount, plus a bit more for the safety margin, is what you need to start the business. This is the startup cost. I take this loan back to 0 again. You can see the startup cost basically is 348, £200 plus the early losses. So you'll need a couple of, maybe £400 to cover that. Is that a realistic amount for you to invest or borrow? If you're paying interest, add the interest payments to your cash flow forecast. So the total you need to borrow will be higher. Cash flows can be done on paper, but it's much easier, as you can see, using a spreadsheet. And there's a free template to use at tencommunity.net, tencommunity.net, in the resources tab under Mind Your Own Business. The first tab on this template is an example with some notes, and the second tab is for you to add your own figures. Then you can delete the first tab and use this as part of your business plan. Finally, will your business be profitable? Whether your business is viable comes down to 2 questions. The first is, do you have enough cash? Answered with a cash flow forecast. The second is, will the business be profitable? We've worked out operating profit, but that is not the end of the story. To work out if your business is profitable, there are other costs to consider. Your profit needs to cover these things. 1, your salary. Work out how much you need to draw out. If you have a job, maybe you can carry on working while you build up the business, so you don't have to draw out any pay for yourself from the business. Now, the first business I started, I didn't pay myself for more than a year, and I existed on other income. Secondly, the cost of any loan you've taken out, include that needs to come out of profits. And thirdly, equipment replacement costs, known as depreciation. Depreciation will not affect initial cash flow, but it does affect profitability. In this example, the sewing machine, which costs £200, will perhaps need replacement in 10 years' time. So set aside £20 a year so that in 10 years' time you have the money set aside to replace it. Do the same with other equipment you need, such as computers. If you are not making enough money to replace worn-out tools, the business will eventually fail. So you now know if your business will generate enough money to be successful. If the business looks profitable, go ahead, make it happen. However, if the business is clearly loss-making, choose another idea and repeat the research and financial forecast. But it may be somewhere in the middle, in which case, think about how it could be more profitable. Here are some ideas to make a business more profitable. 1, are there any other income streams you can generate? If you're selling biscuits, could you also sell cakes or set up a cafe or run classes in biscuit making? 2, could you sell more, for example, by selling to shops in nearby towns? 3, could you increase your price, for example, by making a luxury product at a more profitable, higher price? Or if you plan to sell to shops, could you also sell direct to the public? 4, can you reduce your costs? For example, if you're renting your premises, can you negotiate with your landlord to reduce rent or have the first month rent free? Can you buy equipment secondhand or rent or borrow it? 5, can you reduce the loan amount you need by paying suppliers later or obtaining customer payments earlier? But be realistic. If the business looks like it will not be profitable, it's better to know now when you're planning than when you've actually started spending money. Next time, we'll look at setting up and running a business. Meanwhile, if you're ready, work out your fixed and variable costs, prepare a sales forecast, P&L forecast, cash flow forecast, and equipment replacement plan. Will your business be profitable? If it doesn't look profitable, even after seeing how you could increase revenue, reduce costs, or improve cash flow, think of another idea on your short list and go through the same process to see if this idea is profitable. So